In the past 10 years on our wealth journey, we've never came across a wealthy person or multimillionaire that said they were wealthy because they had a life insurance policy.
Unless they were trust fund babies.
Yeah. My name is Derek.
Money from life insurance too. You never know.
Yeah, exactly. And I'm Carmen. And in this video, we are joined with Andrew Stafford. He is our friend and business partner. We are so jazzed to have him on the call because Andrew is the president of Prevail. So what we want you to know about Prevail is they are actually our partners in this whole insurance journey. And the reason being is because what we wanted to do was align ourselves with other agents and financial professionals who not only had the same values that we do, but also understand the same financial principles so that we can continue to serve a larger audience. And so we have 7 agents with the Prevail team, all managed by Andrew. And it's just been a phenomenal experience to be able to work with individuals who are specialized in cash value whole life insurance, but also have so many other disciplines. For example, we have an individual who specializes in retirement planning, another one who specializes in real estate, another one who specializes in business strategies. So we love the ability to be able to come together and learn from one another, and also just being able to serve our clients' specialized needs. So welcome, Andrew, to the Wealth Nation family.
Well, I'm excited to be here, and hello, Wealth Nation crew. It's quite a following you guys have. You've done one heck of a job, and we're blessed beyond imagination to be partners with you.
Yeah, one of the benefits I would say is, in over the 400 videos that we've done, you want to make sure that you have good talking points. And our conversations that we've had with you, especially when you introduced us to the idea of having exposure to the market, it was key. And a lot of the talking points that we have on our weekly calls, we talk about in the YouTube community.
Yeah.
So thank you.
Yeah. So, and with that, what you all see is you see Darius and I on the screen all the time, but you don't see all of the soldiers in the background. That's why we wanted to be able to bring Andrew to our video today so that we can just showcase his knowledge, because he has so much information in that beautiful brain of his that we just want to unpack and share with you all today. So let's go ahead and just jump into
First of all, the fact you called me beautiful makes me even feel better. Coming from you especially.
You're welcome. I got you. Well, let's go ahead and jump into the content. So we have basically, we want to just have a natural conversation, right? About life insurance, about infinite banking, about how to use cash value life insurance. And the biggest thing that I want to start with, Andrew, we're all here with the Wealth Nation crew. And the idea is we talk about the term infinite banking. Right. And Darius and I know why we use this term infinite banking, because it's a keyword on YouTube and that's what people are searching for. But what do you think is why the public is stuck on this infinite banking concept or theory that we talk about?
Well, I do think there's an aspect of it that's a marketing tool, because, as you mentioned, that's what people are searching for. I guess what I'm questioning more is the intent behind what people are searching infinite banking for, right? So that's the common word. I think when it's properly utilized, the key aspect of infinite banking is the liquidity and the access to cash value that is really so important. And I think that's probably the key takeaway. The second thing that I think is really important that most people don't understand is the fact of leverage. And the ability to have something grow while it's deployed is very unique. And so it's easy for somebody to understand when it rolls up to the term infinite banking, but I would relate it to, it's kind of like our brain. You're only using about 10% of the capacity when you think of it truly in that concept. And what I would say you guys do is not, it's so much more than that. And what started as this concept with Nelson Nash, I think, has been abused, to be honest with you. And no investment vehicle should be all or nothing, right? And I think as we look at the proper use of a whole life policy, is so broad and so vast, and the general public doesn't understand the tool. And I don't blame them, because there's so many different people out there that are slinging different products and doing it for the wrong reasons and not developing the chassis correctly. And so it's just like anything in life, right? There's good and there's bad. But when you properly utilize a whole life policy and you understand the capacity of what it does, it is so much greater than just an in and an out of money.
Mm-hmm. Mm-hmm.
Now, where do you think it is where, well, I understand the part where we say people use it as like a sales gimmick to sell life insurance because that's where you get paid. The other piece of it is the effort that you have to take on the other end to understand the investment vehicle that you're going to be investing that cash value in. Is there investment vehicles where people can buy and they set it and forget it? Or do you have to build up some type of knowledge, and kind of muscle memory of how to develop an asset so that you can get to a certain point to where it's generating a cash flow, free cash flow that you want it to?
Yeah, that's an awesome question. And I want to take a step back, I think, Darius, because, when you use the term gimmick, it's almost as if it's not real or something like that. And I think that it is real, right? And the people that utilize the policy from, an in and out standpoint, it does do that. When I talk about it as when I say a marketing tool, it is a key word that's searched all the time. And so people that are searching for that, number one, I do think you want to figure out what it is they're ultimately getting at. But what I'm trying to articulate is the product it should be utilized more as an asset class, not the end all be all. This is everything that should be done. And that's where I think the whole process goes awry.
Mm-hmm.
If you're going to build any type of long-term wealth creation, you can take a look at a couple of different, experts or wherever you want to go. You can figure out how do people create wealth. And one of the things for us that we do a tremendous amount of research on is looking at the endowments and how the endowments build a portfolio or wealth creation. And for the most part, they continually outperform the benchmarks. You won't go to an endowment and find it's all in the market or it's all in real estate or it's all in research or insurance. What you're going to find is they look at how do you build something that isn't correlated with one another.
Mm-hmm.
Because when one thing could be up, the other one's down, and not all returns happen exactly the same time in the same time frame, and markets go through crazy cycles. So a whole life insurance policy properly structured, if you look at it as a segment of your wealth creation, as an asset class, it should be right in line with investing in the market properly, right? And it should be right in line with other alternative asset classes. And when you dive into why it should be looked at as an asset class, the markets have built-in volatility, but there is nowhere you can go to get the level of growth long-term that you can get in the market. But an insurance product like whole life properly structured shouldn't compete with that. It's not meant to get equity style returns. And if you're buying something that's simulated in equities or trying to get equity style returns, it's not insurance, right? It is something else. The insurance, if you properly look at the whole life chassis, is built to be a very conservative mechanism. And why? Because it has consistent growth. It doesn't go down. It's not volatile. It's liquid. It is a different asset class. And this whole industry, because you go and it's easier to sell, imagine throwing an illustration in front of somebody, right? And showing them 6, 7, 8, 9% returns every year. And then they'll come back and be like, well, we threw a couple zeros in it. It doesn't work like that, right? The sequence of return in any type of investment is so impactful. So I can show, and we've got an illustration where you can have a 20-year period of return. Both of them get a 4% rate of return. The sequence of return in the front side versus the back side versus the middle could be a 2x multiple on what your ending value is. But yet it's still a 4% average rate of return. So when you look at whole life and why it is so key to wealth creation, is the same reason people used to, when you would have extremely wealthy people think about buying fixed income or bonds.
Mm-hmm.
They're not buying a bond to get an equity style return. They're buying a bond because it's a safe place to put an asset with a consistent rate of return that you can count on.
Mm-hmm.
And then you get your growth from somewhere else.
Mm-hmm. Mm-hmm.
So that's why I just think when we look at this industry and we look at what it is, and look, there's a tremendous amount of good people out there that that work in the insurance industry and the wealth management industry. But you do have to be really cautious of, are they looking out for your best interest? And always and never is not good in anything you're trying to do building financial. Always do this, never do that. You hear that, probably should ask yourself, is that the right person I should be talking to? And the reason I say that is market cycles change. What people should, if you look at bonds, let's just take bonds from an investment standpoint. Revert back to 3 or 4 years ago. That was your fixed income safe money, and interest rates were extremely low. And bonds in 21, the ag bond index was down. That's your safe money. The ag bond index was down in 22, like 12, 13%, give or take, depending on what you're looking at. And that's your safe money. But the problem with it is it can't rebound like an equity rebounds, right?
Right.
So it's up 2 or 4% this year, depending on which index you're looking at, but it was down for 2 years in a row. The reason I say that is bonds probably wasn't the best place for safe money 2 years ago. But now that we've had a rising interest rate environment, fixed income looks totally different. Bonds is a great place to have a portion of money because the rates have come back up. So the only reason I bring that up is always and never is generally not good in financial investing.
Yeah. Mm-hmm. I'm so glad that you said that, because that also kind of alludes to the conversation that I was thinking that we get often is, I'm never going to invest in whole life insurance. And by the way, folks, we can't even say whole life insurance is an investment for our license standpoint. So if somebody is telling you to do that, it's not correct. So the idea that we keep getting this conversation over and over again is, why do you feel like people are having this conversation of, I'm not going to invest in whole life insurance?
I think it comes to return. And they don't fully understand what the tool is meant for.
Yes.
It is a supplement to wealth creation. And again, going back to, it's not meant to be an investment or like an equity style return. Mm-hmm. So if somebody rolls up to me in a Tahoe and a Corvette rolls up next to it, right? That's basically what you're comparing between the two. But yet they're both vehicles. I can drive both of them to the store, right? But one can go really fast and only carries 2 people, and one can carry 8, and you shouldn't drive it that fast, right? But that's exactly when we're trying to compare these things. So when people say, oh, I would never put my money into the whole life vehicle, the number one question is, do you understand it?
Yeah.
Right? And they may be right because of the life cycle they're in.
Mm-hmm.
Right? But it also could be, do you understand what the tool can do? Do you have any other tool in your repertoire that's fully liquid as far as the cash value, right? That is a non-correlated asset to the stock market, that doesn't have volatility built into it like the stock market, that the cash value inside of it, when it's properly structured, can grow tax-free, right? That you can pull income out of it, or you can pull cash flow out of it and policy loans tax-free, that a death benefit can pass on tax-free. There's not a lot of things like that. So going back to the scenario, sitting at the red light, who's going to win, right? 0 to 60, the Corvette, because it should.
It was designed for that.
It was designed for that. But if I got to take my family to the store and I want to make sure I'm going to get there every single day, whether it's snowing, raining, hurricane outside, I'm jumping in the Tahoe because it's consistent and I know what it's going to do.
I love that analogy.
Yeah, I love that analogy because it also gives me a picture of the fact that environments change. Our economy changes, and we have to build things differently depending on the environment that we're in. Right now, we're in an environment of high inflation. And the topic has come up because we're so up and down, is whether or not our dollar will be able to maintain itself? What happens if the system crashes and we're no longer using the US dollar as our reserve?
Let me go buy gold. Oh no.
Let me not put any money in a life insurance policy and just save my cash when that's not the case. So where does gold fit in as an alternative commodity when we talk about building the puzzle of our asset classes?
So this is a really interesting topic because it comes up all the time, right? And so I guess the first question that I would ask is, if not the US dollar as the main currency, then who? Right? And the number one thing people will generally come back and say, well, what about China's currency? They're trying to replace the US dollar as the world global currency. What about, the UK? What about Japan? What about Germany? They're all strong, right? So you look at it, and the first thing that I don't know if people understand is people generally are concerned because of the amount of US debt, right? So you look at, we're $34 trillion in debt. And that is concerning, okay? But the US right now is running, and the numbers give me plus or minus 5 or 10%. It's not going to be exact because I'm pulling it off memory, but we're running roughly 123% of GDP in national debt in the United States, okay? Japan runs 255%, okay? The UK is 104. China's total debt is 279 of GDP, 279% of GDP. So we're the worst, we're the best of the worst, right? And so I guess the thing that I would ask is, we are in a global debt crisis, not a US debt crisis. And when people talk about gold, the second thing, first of all, gold can be a really, really important aspect of wealth creation. It can be. But when we talk about the hedge or the currency risk or whatever the case may be, there's a couple of things I'll ask. Well, how much is your gold worth? Right? And they'll come back and they'll be like, well, I don't know. It's $2,000 an ounce.
Dollars.
She said dollars in there. And they say, well, what if it benchmarks to something else? I can tell you this. Currencies rise and fall in value. That happens. But if the US dollar goes to zero, right, you better have an armored Tahoe because the world is coming apart. And the last thing you should be worried about is how much gold I have, right? Because if you can't defend it, somebody's going to come and get it, right? The whole thing is gold is critical. It can be a hedge. But let's look at the last 2 years in gold, right? So you take the last 2 years. I think I'm gonna look something up here real quick. So we had in the last couple of years, we've had a high of, call it $2,050 an ounce, and we've had a low of, call it $1,660, give or take. You're running. So 3 times it's hit the $1,600 level, and 3 times it's hit the $2,000 level. Wow. Think about that volatility for a second.
Just a little bit, yeah.
Now, what it tells you, it's following the market.
Yes,
that's what the market has done. So everything is so attached to one another, including our currency, that, could the US dollar be devalued? It could be. And it again, it rises and falls. But if not us, then who? Because no one else is in a much better position than we are. And when you look at the main competitor, which happens to be China and the one that they talk about all the time, their economy's struggling dramatically. They've got a middle class that is really challenging. I want to leave you this one other aspect, and I think that this is really interesting. So if you look at the world economy, okay, and GDP by country, the US runs 25, 26 trillion. China runs 17, 18 trillion. Okay, so we're the top 2. What do you think the next closest competitor is from an economical standpoint of GDP? Which country? Just take a guess.
Germany.
Germany? Okay, that's pretty close, Carmen. Germany and Japan run about 4 trillion in GDP.
Jeez. Wow.
Okay. So
let me
California
guess.
and Texas California and Texas have GDP as large or close to
The
the
countries.
next competitors down the list.
I was thinking California, actually. What were you
Well, you
going to
said
say?
countries.
Yeah, yeah. But in my head, I was like, California, because I know they're always strong.
If you took our 4 largest GDP states in the United States, you took California, Texas, New York, and Florida, those alone would be the 3rd largest country as far as GDP is concerned, running at about 10 trillion.
Good Lord.
So who's the next? I was gonna say Brazil.
No,
No.
I think, well, you got India up there and
Yeah,
some of
yeah.
those countries.
India.
But
Yeah, yeah.
here's the thing, they all run, the gap is so vast, right? It's so big
Yeah,
that
yeah.
they all run so much less. It's the US and China, and there was a discussion that China would take over the US economy as far as being number 1 in GDP, but now their economy slowed so much they don't even know if that's going to happen. But
Yeah, yeah.
so let's go back to your general question, right? It's like, well, where do I put my money?
Mm-hmm.
So if you look at the major insurance providers, right? And again, it's still in US dollars, but I think we've argued that the US is always going to have a major role economically. I don't know what New York's is. It's pretty close, and Northwestern Mutual and Mass Mutual, kind of the 3 largest whole life non-direct, providers. Mass has paid a dividend since, I think, what, 1869 every single
Yeah,
year.
yeah. Yep, yep, yep.
Now, I want to take yourself back, because we feel like the world's falling apart right now. You look at television, and you get online, social media, and for some reason everybody hates one another, and you can't figure out what's going on. You can't get real news. Imagine what the people thought. Imagine what our society in America thought during World War I. Imagine how they felt things were falling apart. And then you go to World War II, right? And then you go on and on and on. You go to, the Vietnam War, and you go to all kinds of political things that have happened in the United States. We've had presidents assassinated. We've had Watergate, where people, we had great issues politically. We've gone through so much.
Without access to information like how we do now.
Well, number one, without access to information, but think about this. You can look at what the markets did during those time frames, and it was very volatile. But the large insurance, specifically Mass, they haven't missed a dividend once. So I don't know. I can't sit here and say what should someone do with their money, because I don't know everybody's in particular situation. But when I think about someone who has stood the test of time,
Absolutely.
that's a pretty strong sentiment.
Yeah.
Now this can even go back to the point that we talked about initially, or that I mentioned initially, is that wealthy people don't talk about life insurance, but they have it.
Yes.
They don't talk about it. They don't say I'm wealthy because of this, but as a portion or as a piece to maintain that wealth that they do have. They do
Well,
have
what's
life
more
insurance.
fun, right? To go into a cocktail party and talk about Nvidia being up 200%, or my life insurance cash value that's grown, at a consistent rate for the last 30 years and is probably a bigger number.
Yeah, yeah. And just going back to the Corvette and the Tahoe, who wants to talk about a Tahoe when they can talk about how fast their Corvette's going?
Exactly. Believe me, I don't know which one, what type of things drive, but no one's going to, when you pull into the gas station, no one's coming up and asking, what is that in a Tahoe, right? They know what that is. You roll into a really nice vehicle into a gas station, people come up, what is that, right? Mm-hmm. It's just different. It's fun to talk about it. It's exciting. That as society, we get the spice of volatility makes people want to be a part of it. There's a scarcity. They think, oh man, if I invest in this, I can become super wealthy.
It's the FOMO.
That's not how the wealthy creates wealth, right? Mm-hmm. When you look at, for the most part, very wealthy people, where is the greatest return on their investment? That most of the time, unless it's been handed down generation to generation, where's the greatest wealth, creation for them?
Oh, I would say
primarily in a business.
Oh, yeah, right? Yeah.
Their greatest rate of return, most of them are business owners or have been a part of a business owner, and their greatest rate of return is inside their business.
Yeah. Mm-hmm.
Right?
Yeah.
And so then if they have a liquidity event or they create wealth from that business, they don't need to go shoot for huge returns somewhere else.
Mm-hmm.
They're looking at preserving their wealth. They're
Yep.
looking at consistency. They've taken a ton of risk in their life, and now they're like, how do I de-risk my opportunities?
Huge point. Huge point. I'm so glad you said that, because as business owners, we were just having that conversation. Business owners spend their entire life, right, risking and risking and risking, growing their business, and all they want is a safety net.
That's exactly right.
Guaranteed.
And you
safety
look
net.
at it and say, when we meet with business owners and things like that, one of the things we're talking about is this is where your wealth creation is right now. This is where your risk is at inside your business. If you have a lot of dollars, you're gonna put money back into your business because it's giving you your greatest return. How do we de-risk some of that?
Yeah.
How do we
Yeah.
provide you liquidity outside of the business that you can access if you need it in the cash value?
Yep.
Right? But we're de-risking your overall wealth concentration.
Mm-hmm.
It's just a little bit of a different mindset.
Yeah, absolutely. Well, with that, let's go ahead and talk about the ways in which a business owner, for example, or anyone who needs access to liquidity can utilize life insurance. We always talk about it from like a debt aspect, but I would really like to know your take from an investment aspect and taxes and retirement and all of that.
It is, first of all, again, the terminology utility knife comes up all the time, and it's cliche, but it really is, right? You can have business owners that can begin allocating funds to buy out another partner, right? You can have business owners that are generationally passing wealth on. You can have business owners that use it as a capital bucket, right? And maybe they've insured some key men that are critical to their business that the death benefit is important for, right? Should that person no longer be in the business, but the cash value accumulation becomes really important. And here's what's critical, and business owners get this, which most individuals don't. Business owners are very accustomed to talking about profit and loss and balance sheets and things of that nature. And when you understand that a properly structured whole life policy as a part of your strategy is really a balance sheet asset transfer mechanism, it's not an expense.
Yeah.
It's you're transferring from this account, which may be excess free cash flow on the balance sheet, over to, right, the whole life policy, which grows the same way and you have access to it. When you think of it as a balance transfer versus an expense, everything changes.
Yeah,
Right.
it's a complete mindset shift. I remember even seeing that like drawn out for us, and it was like, oh my Lord, this guy's just opened up, and there is hella opportunity.
Yeah. So even business owners that look at it and say, all of the mechanisms for most business owners to save for retirement are challenged, right? There's limits, and a lot of it is a pre-tax deferral, and you can do cash balance plans and things like that. But again, you lose the accessibility to it the more that you can use some of the standard vehicles.
Yeah.
You
Yeah.
look at building a properly structured whole life policy, right? And you can have a cash flow mechanism down the road that can operate like a pension style income for them that can be tax free if it's properly structured, right?
Mhm.
I mean, the accumulation mechanism inside the policy, if the whole life policy is structured correctly, is so boring but amazing, right?
Right.
And again, going back to that sequence of return, the fact that it's going to, the dividend growth, most of the policies, if they're structured right, you start getting cash flow positive, as you go down a few years, and all of a sudden every dollar is starting to work for you. You can access it. That's what most business owners really, really want to understand, is what's the liquidity.
Yeah.
Because they've all gone through some point in their life, unless the business has been handed down from a different generation. If you've started it, for the most part, you remember a time when you're laying up at night and you're like, I don't know if I can make payroll tomorrow.
Yep.
Mhm.
Yep.
Right? I don't know if I'm going to be able to pay my people or pay these vendors, or I got to stress cash flow out. And fast forward 10 or 15 years down the line, they could be unbelievably successful, but they still have that burned into their brain. And so
Those long nights.
Yeah.
Yeah.
they operate from more of an element on that side of things, an element of fear of failure versus opportunity for success. That they're successful, but they think, man, I always want to have liquidity. I always want to have access to capital for two reasons: to always never make sure they're in that situation again. But as they get more and more successful, to take advantage of opportunities that come that they want to pounce on quickly and not go to a traditional bank and have some 25-year-old sitting there trying to gather information so he can take it to a loan committee 2 months from now.
I'm so glad you mentioned that. That I can say personally from our perspective, what we have talked about like in the past as we were trying to grow our own liquidity, how we missed out on opportunities because exactly what you're talking about. And now because we have the Swiss Army knife or the utility tool, multiple of them, it allows us to have that liquidity where we can take advantage of opportunities very quickly.
Right. Now, a part of retirement and making sure that you have yourself set up for it, we can't have a conversation about retirement without talking about taxes, because there's pre-tax dollars that people are used to putting into their retirement vehicle. There's tax dollars they're used to putting in retirement vehicles. When we talk about retirement and using a whole life insurance policy in the place of it, because again, when we talk about 401ks, business owners can't use 401ks because they may have too much money. How can we use this?
Well, they may be able to use it, but they're capped, right? So
they're capped.
like if you think about a business owner, and let's just take you could search online and find out how much should I save for retirement. You're going to get a multitude of different responses, but let's just use the average of 10%, right? Well, 10% is relative because of the caps that are built into our system. 10% for 90% of America is fine. But if you have a certain income level as a business owner and you think of a 10% retirement savings rate, 2% of that is available to go into a 401k because you get capped out.
Yep.
Right.
Yep.
And then you get to a certain age and you can put a little bit more in, but it never really reaches the threshold. So to your point, Darius, I think what is so amazing about utilizing the policy is the aspect of creating this liquidity bucket.
Yeah.
Right. And it's critical that always, and we've talked about always and never is bad. So there still should be investments in other areas, whether it be the market, it could be real estate. There needs to be high appreciating opportunity investments in someone's portfolio elsewhere. But what is amazing about the tool, again, if it's structured properly, is let's assume that you're pulling out, pick the number. I really don't care because everyone's situation is different, but you're pulling an income out of your retirement savings that is non-life insurance policy. And let's say that the market has a terrible year, right? You're in 2022 when the general markets were down anywhere from 15 to 25%. And you still need that same number that you needed before, but now with your values down, that percentage is higher. That crushes your long-term wealth creation when you have to pull that same number out in a down market. But imagine being able to not take the money from the markets, and that year you pull it from the policy, okay? Allow your investments to rebound and come back up, and then you turn the income back on the market. And oh, by the way, with the appreciation you got in the markets from the rebound, you put the money back in your policy.
What?
Right? So the appreciation repaid it. You didn't lock in losses, right? When pulling income came out at the low period, and your appreciation come back, replenishes that. You are in such a better position long-term.
Right.
I love it. I love how you say that. And I'm such a visual person. So I keep going back to our conversation of like the Tahoe versus the Corvette. And I'm thinking, oh, it's a little bit rainy and a little bit slick on the roads. You know, my Corvette tires aren't going to perform that well. So let me hit my Tahoe, you know?
That's right.
It's this analogy keeps coming. It's giving a lot today.
Now there's another conversation, another question that we get, or let's just say conversation where people, let's say they're a business owner and they have investments, and the conversation is, why do I need life insurance? Because I have my investments to take care of my family in the event something happens to me.
How do you answer that?
Well,
what's your take on it?
I think that the first of all, again, everyone's situation's different.
Of course.
And so I'm not, to speak more in generalities, I would ask them, do you want, you're going to have some form of estate pass on, and depending on whether or not they've done proper planning and trust, some of that may go to taxes, some of it may not, but the death benefit that can replenish or provide assets is done at X cents on the dollar, right? So the death benefit leverages up. So the real question that you have is, do you want to leave a legacy or do you want to live a legacy?
Mm-hmm.
Imagine sitting and saying, yeah, we've got all these assets for my family. And a lot of people will sit in our office and some of them want to drain the assets, right? They're like,
Yeah.
my kids are fine. I'm going to live my legacy. And some people are like, well, I want to leave my legacy. Well, what if we show them the ability to leave the legacy at a reduced rate of cents on the dollar, which is ultimately what the death benefit does? The other thing is the tax-free pass-on aspect of it.
Mm-hmm.
And if somebody then says, hey, I've got all the investments I need, I don't, my wife and family is fine, that may be true. And it just might not be right for them.
Yeah.
Right.
Yeah.
And there are people out there that it's just not right for. But the other thing that you can look at is say, well, okay, maybe I can pass this on to my children, but I want something for my grandchildren. Right. And so let me insure my children. I'll still own the policy. I'll still have access to the cash value while I'm living. Let me insure my children. And upon death, that policy passes to the children. And upon my children's death, then the death benefit passes down to my grandchildren. There's so many different things you can do, as far as skipping and creating long-term family wealth creation. But again, I would just look at it and say, if it's in an IRA, for example, and they're going to pass an inherited IRA onto their family, well, the new Secure Act 2.0 rules will force their family to withdraw that in a 10-year period.
Yeah.
So you're going to take your kids, let's just assume you might take your kids that are not in their peak earning years like you are, right? You're going to take your kids and they inherit that IRA. You're going to drive their tax rates through the roof because they have to drain the IRA in 10 years.
Yeah.
There's more effective ways to do it.
Yep.
So you could look at it and say, if I want a more efficient tax way to do that, maybe depending on the situation, I use my IRA assets to fund the policy while I'm still living. And then you pass a tax-free benefit on, and the IRA assets were spent down during life. And you recreated the value of the IRA in death benefit, and that passes on tax-free instead of I passed the IRA on and they got to drain it in 10 years and wipe themselves out with taxes.
100%.
Right. And it's still a part of the conversation of concentration, because let's say somebody has investments in real estate and they say they're going to pass on these rental properties to their family. Still begs the question, what happens if there is a time where the real estate market isn't good? What is your family able to do when people don't have to pay rent for an extended period of time, like we saw during 2020? So it's all about concentration. And again, it goes back to making sure you have that puzzle complete to a point to where if something's not working here, you can get your income from someplace else, or the ROI from someplace else.
Yeah. And I think it's critical. You do bring up a good point. First of all, again, I want to reiterate, it would be foolish for me to say I would know what anyone's situation is. But for the right investors, real estate can be a great, or exposure to real estate can be a huge wealth creation tool. And it also generates passive income, which when you think about wealth creation is so important. If all you rely on is the underlying asset value going up and down, and when you want to create liquidity, you have to sell that. You may be selling it in a down market, you may be selling it in a high. You're beholden to someone else. Your motto, take back control, right? Own your future. You can't own your future in an asset that you can't tell when it's going to be up or down, and you have to sell it to liquidity to get a liquidity event. So real estate produces passive income. Not all real estate is equal, right? But it is a good wealth creation tool. When it's properly structured, it can pass on. But when we think about it, that should be a sliver. And then you have a sliver of growth investments, right? As we talked about at the beginning, that we go back to, that is maybe market related. And then there's a sliver of utilizing whole life and cash value. It's just, you got to kind of take someone's picture and figure out, how do we get all of these fitting together? But your initial question about the concept and why people search the concept, they're looking for some way to create wealth, right? And they think that this will help them create wealth, and it will, and it can, but they're only thinking about 10% of what the tool can do.
Totally.
Right.
Totally. Yeah. They're only using one feature in the Swiss Army knife. Right.
Now, we've talked about a lot on this video. If we were to take a step back and talk about overall, what are the things that you offer, that we offer together, where someone can start having that conversation? What is the income that most of the clients have, and what are the directions that you take them in through the Prevail journey as to maintaining their wealth and extending that wealth through the things that you offer?
Well, so I think that when you look at the industry, Darius, there's a lot of people out there that want to gather assets, right? And basically just give us your money and we'll manage it. Give us your money and we'll manage it. Give us your money and we'll manage it. And there's a lot of really big names that's what they do. And by the way, there's a lot of really good investment professionals out there.
Absolutely.
There's a lot. And your audience may be with one that's just phenomenal. I think that we look at it from a different standpoint, and how we work with our clients is not just trying to manage their wealth, but how do we help them create it? And how do we look at every different aspect of their life? Examples of people will come and be like, should I pay my mortgage off on my house? I've got all this cash sitting there. And maybe they should, maybe they shouldn't, but running scenarios on a 10 or a 15-year decision versus right now. Because it's not about moving the money from this bank account over and paying the mortgage off, right? It's about what could that asset do over a 10 or 15-year period. Mm-hmm. And so if you're going to pay your house off, it maybe grows depending on what market you're in, but let's say it grows at 3 or 4% on an annualized basis, the appreciated value of your house. Well, there's a lot of other things that you can do on a conservative nature that would invest or appreciate faster. Yeah. And when you take that over a 10-year period, that's a major decision versus today, they feel like they're making it in a silo. So we believe a couple of things. We believe taxation is critical in investing, right? We also believe that having your portfolio not all correlated to one thing, no matter what that one thing is, it shouldn't all be correlated. And the answer to that inside the industry is, well, we diversify you in a bunch of different, mutual funds or ETFs or portfolios. That's not diversification. No. The market has gotten so complex, right, that the overlap, you can see it when one thing goes up, it all goes up. When one thing goes down, it all goes down, and it happens in unison. So making sure that you don't have concentration risk in what it is that you're doing. And then the last thing is passive income is critical. If you take an investment portfolio side by side, no matter what the return is inside of it, if one of them is generating passive income long-term, it, for the most part, generally outperforms a like return because of the way that it's constantly producing income versus just being reliant on the underlying asset value. We are extremely close with understanding the objectives of our clients. What are you trying to accomplish? Yeah. And then designing the right plan to accomplish that goal. And how that relates to a real world person. Most people walk in and say, I want to get the most amount of return I possibly can because I just want to accumulate wealth. If you understand what the objective is and how much they need to retire or to do whatever it is that they're doing, they might not need to take that much risk. They might need to only take X amount of risk to achieve their goals. But they walk in thinking, I want to get the best return I can and hopefully outperform everything. And ultimately, the more risk you take, the more downside is going to probably happen when the markets cycle.
Yeah, 100%.
Mitigating downside risk is one of the most important things in investing, because then you don't have to take as much risk on the upside to make up for the downturns.
Mm-hmm. Yeah, I'm so glad that you've communicated that and asking that question, Darius, because that's another reason why we found it so I'm trying to find the right word, important to be able to partner with you, because what we recognize is that with us being able to sell life insurance policies, we knew that it's not the end all be all, and there has to be some sort of wealth creation. And we were always looking to be able to work with individuals who, one, had the credentials to be able to invest in the market or invest in other opportunities, and had the sense of understanding the asset that whole life insurance is and how it can help be, whatever type of tool that you needed in your financial puzzle. And I can't say enough for the opportunity that we continue to have every single day to work with you, to work with the whole team, and just to be able to spitball off of each other. Because as you all see, folks, Andrew is a wealth of knowledge. And every time we talk to him, we're always learning and just thinking about how can we apply our own finances in different ways. So, Andrew, I just want to thank you for being there for us.
Well, we're blessed to be a part of your team.
I was actually going to mention the same thing, but I was going to say it from a personal standpoint.
Go ahead.
I love the fact that we're able to help people, but I think, honestly, more importantly, I'm glad we're able to help ourselves. Because
put your own oxygen mask on first.
You have to put your own oxygen mask on first before you can put on your neighbors.
Yeah.
So when coming into the relationship, we knew a lot about life insurance. We knew we knew a lot about life insurance and borrowing from life insurance, and that was to the extent. But after a couple years of working together, we really started to understand those different nuances and how other people, the different scenarios, are using their funds and growing their wealth outside of just this idea of borrowing from a life insurance policy that has really changed our education. It's grown our education exponentially in regards to financial literacy and financial well-being that I want to thank you for from us personally.
Yeah, well, we appreciate it. You've got an unbelievable community. What I love about your community is their desire to learn. They constantly are trying to improve themselves and their lives and their families, and they're just great people to work with. And we're excited for all the things that are to come. I will tell you that as we leave it with this, and I love what you guys have said. Properly structured whole life policy is probably one of the largest misunderstood tools in anyone's wealth creation repertoire. And like anything, the more that you are working with somebody that understands that and can help educate you on that and give you the nuance of it and the way that it works, which you guys do a phenomenal job of, the better off that you're going to be. And I'd leave you, remember, it's apples and oranges. It's the Tahoe versus the Corvette. Don't expect it to run like a Corvette. Expect it to be able to climb a mountain when you need to climb a mountain.
Absolutely. How's your Corvette, by the way?
It's awesome. Love it.
All right, Wealth Nation, thank you so much for hanging on with us. Andrew, thank you again for your time. And Darius, you have something else you want to say?
Well, one thing I want to leave everybody with is normally when you get a life insurance policy, you get one agent. When working with us, not only do you get a team of people that can design policies, but you also get a team of financial wealth around building wealth, not just with life insurance, not just with retirement, not just with stock investment, not just with real estate. You get a wealth of knowledge that you can plug into just by working with us. So when you're looking for a knowledgeable advisor about how to generate and create your wealth, don't think about it just from one aspect. Think about it from a holistic aspect in what you're able to get. And those are some of the things that you can get when working with Wealth Nation and Prevail.
Absolutely. All right, Wealth Nation, thank you again for your time. And don't forget to own your own lifestyle.
Or someone else will.